AdLib is the DSP-agnostic buying platform to scale your programmatic campaigns smarter, faster, and more profitably. AdLib helps independent agencies and marketers deliver premium programmatic performance without the complexity, cost, or overhead of traditional DSPs. Their platform provides the tools, data, and automation to run enterprise-quality campaigns, from CTV and audio to geofencing and YouTube, all under one roof with zero trafficking headaches. Plus, they're not just a platform, they're your growth partner. The AdLib team helps you win new business, expand budgets, and deliver measurable ROI that keeps clients coming back. It's time to unlock programmatic. Join leading marketers worldwide who are using AdLib to deliver more campaigns with better results. Check out getadlib.com. Welcome to Open Market, a podcast about building companies in the advertising industry. I'm Joe Zappa, and I'm joined by the illustrious Eric Franchi, who is going to play Luminary today.
Luminary. How you doing, Joe?
Multiple light words. Eric, I joined a call recently with someone who listens to the pod, and he was like, "Oh my God, you sound so uninterested to see me." And it's because he's used to my pod intros that are like very colorful and energetic. And I was like, that's just my pod voice. Don't worry. I sound very uninterested relative to the pod intros generally. It's not personal.
I never get any criticism when I speak to pod listeners. They're always happy to hear from me.
I'm sure they are, Eric. I'm sure they are. And that's a good segue into our topic of conversation today, because a lot of people want things from you. Me, they don't want things from me. I'm just fucking selling them shit. But you have things they want. So today we're going to talk about fundraising do's and don'ts. And I'm just going to ask you to walk through some of the do's to start. And then I'll ask you some follow-up questions. Sound good?
Yeah, no, it sounds great. The genesis of this is twofold. First is it's fundraising season, SDN, and my inbox is inundated. A lot of companies are in market in Q4. So I'm just kind of seeing some patterns, and it reminded me, like we haven't done something around necessarily how to talk to VCs from a VC perspective. There's one. And then two, we had an awesome episode with Jason Fairchild talking about this from a founder's perspective, which everybody should listen to. So maybe a little bit of a mirror image on this. And to be clear, the purpose of this is not like how to run, a 12-week process, how to run diligence effectively and everything like this. What I'd like to do is speak to the founders that are trying to get their first meetings, trying to break in, trying to set, I think, the right tone, the right first impression to earn your way into the subsequent opportunities. If you got a good business, you're gonna get there, but you need to kind of start on the right foot.
Yes, this is some of the tactics around fundraising. And if you do have a solid business, how do you actually make the most of the opportunity and connect with the right people? Okay, so your number one do was get a warm intro. Explain.
Yeah. This isn't just about getting a warm intro. It's a proxy for having some level of, a minimum like familiarity, at best a level of trust or implied trust with a VC. The world of investing, for better or for worse, it kind of runs on trust and runs on reputation. So in many cases, the best way to, get an intro to or start a conversation with an investor is actually having somebody speak on your behalf, because of that, kind of implied reputational credits that they're using on your behalf. The other side of this is the best fundraising conversations come from a place of the investor is familiar with you. They're familiar with your business, and, they've talked to you kind of like off cycle, so to speak, not during a fundraising process. So the ideal is not just like get a warm intro. It's don't start from zero and expect like cold outreach to be the best thing here versus an enterprise sales or things like that. Like cold outreach can work.
Yeah, it's the same as sales, right? The ideal is that the first time someone hears from you is not when you're saying, "Give me money."
Exactly, right? And that's where it connects to a lot of the conversations we have here on the pod, which is like, make sure you're generating the right level of awareness with the right audiences. So some of that work is done for you before you step into the room. And look, I don't want to come off as like, you got to be part of the club. You got to be part of the ad tech mafia. I've heard of. You do not. You don't need to have like Bill Wise, like risk his reputation, emailing me saying you have to have a meeting with this kid. Like there's ways to do this. I go back to Moffy. I don't know where Moffy came from. Jonathan Moffy, founder of Streamer, acquired by Magnite. One day, he just started popping up and he was there every single day. And I felt like I knew the guy before he ever emailed me. And then one day he emailed me. I was like, oh, hey, Jonathan, glad to hear from you. Let's absolutely get on the phone, right? So I think there's, a long-term way to play this that, doesn't necessarily depend on fundraising cycles. But if you're in a fundraising cycle, the best way to, I think, start off on the right foot is if you can show that, you're either trusted by or work with someone who the firm or the partner respects, or you're resourceful enough to get an intro to them by working your network.
Yeah, and I think what'll happen is when a lot of people hear this kind of thing, the classic like your network is your net worth kind of message, they'll get defensive and they'll say, okay, but what if I'm not a, second time founder? I wasn't an executive or magnate at the trade desk or whatever. But what you're saying, and what obviously I preach all the time, is that nowadays you don't need permission to build a reputation in industry. Like, yeah, it's easier if you already have it, but you can get in front of Eric Franchi every week, just like Moffy did or like I did, right? By just sharing content on the platforms where you hang out. It's not the olden days where you had to depend on third-party gatekeepers to get your message out. That control lies with you. And so you can build your network if you don't have one, but then you got to market yourself. And a lot of founders, and this is where I get really pissed about the like shtick of like, well, I'm a real founder, so I'm just like heads down building my product. I don't have time for any of that like frivolous marketing stuff. And it's like, well, the frivolous marketing stuff is how everyone finds out about the great product you're building and potentially gives you the money you need to keep building it. So it's, they go together. They're not actually in opposition.
Yeah. If you are a killer in that way, I'm sure that there is a person or two that is connected to an investor that you'd love to back your business that can say, please talk to my friend. She is an absolute killer. Like, you just need to kind of leverage the network. The other thing, I don't know if I'm necessarily that big of a fan of this, but I mentioned it earlier, is that I heard from Mark Andreessen once that he prefers the warm intro because it's the first test, so to speak. Like, if this person like can find somebody that they know that's connected to me and can like convince me to, like get the meeting, it's like, all right, you're not that bad at sales. Like you've been able to, do the steps to get a meeting. I don't know.
Well, you're not that bad at sales, or to our point about the modern way to do this, you're not that bad at marketing, right? Because sometimes you can market yourself into that warm intro or into emailing someone who shouldn't know you but does. And I think I actually thought about Andreessen too, because I think he was critiquing the critique of like your network being the key, right? Where he was like, there's obviously like a sort of social justice critique of the network thing, right? Because it's like, who's going to have the network, yada, 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 people with all the forms of privilege we're familiar with. But he was saying, yes, of course that's real. And it is a disadvantage if you don't have that or come from that background. If you go to Stanford, you're going to have an advantage, and certain kinds of people go to Stanford, etc. However, it is easier now than it's ever been to overcome those disadvantages. And so both are true, but it's something to keep in mind.
Very good.
Number 2, send the deck.
Yes. We quickly got into like pet peeves. Standard operating procedure is to have a deck, have a short blurb about your company that accompanies the deck, and just send it. There's a surprising number of founders that bristle at the idea of sending their materials out. They want to have an NDA. They want to, just like, they should take a call with me because, I'm amazing. It's very, very difficult. Like, again, you could be the killer. You could be the one that, an investor will drop everything for and just take a call because, somebody said you have to speak to this person. They're an absolute killer. It's very difficult to do that if you don't just like help bring an investor along, bring anybody along. And the best way to do that is to help them understand what the heck it is you do. So A, like send your materials, and then B, back to marketing, make sure your materials are damn good and get the investor excited. Like, tell the story, show the market, show the pain points, show why you and your team are the absolute people to solve this, show where it can go, like make your materials do some work for you, and also make sure they explain what you do in a way such that it shows the fit with the fund, and people are going to be excited about speaking with you.
Yeah, it's really funny how there are so many corollaries between fundraising and marketing because
Yeah.
this is, of course, a very common issue in marketing as well. I experience it personally in that sometimes I'll have early stage founders be like, can you sign an NDA before we talk? And I'm like, that's really not customary and like, it's really not necessary. Like, I will do it because it doesn't cost me anything. Like, I don't care. But it is almost certain that whatever you're sending your potential marketing person, it's not going to compromise your company, or at least it shouldn't. You should be able to share details about your company without like giving away whatever secret sauce you think you have. And then it's the same thing once you start doing marketing, is some founders are like, well, I don't want to tell anyone about what we're doing because then they're going to steal it. And I'm like, I really don't think that is what you should be worried about. I think you should be worried about this never taking off because maybe you do have something great that no one knows about. I think that's a much bigger danger than someone reading a LinkedIn post and then running with your idea.
Yeah, exactly. On a practical basis, venture capitalists never sign NDAs. And this is one of those kind of like insidery baseball things that many people don't know. So, I don't try to beat up on anybody when they ask, us to sign an NDA, but we talk to any venture capitalist that's any good, talks to hundreds of companies per year, and will invest in companies that at any given point may pivot into something that we looked at previously. It's such just overload coming at a VC that signing
Yeah,
an
if you
NDA,
signed an NDA with everyone, you would not be able to talk about anything.
you wouldn't be able to operate your business. So standard procedure is just like not signing them on that basis. So like write your materials accordingly. Like if there's anything you wouldn't want necessarily kind of floating out there, and use things like DocSend, like totally fine to control the distribution of material, but get the material in people's hands. And then also
Yeah.
make sure your materials are good. Like do the work and put the thought into it.
Number 3, frame the opportunity. How do people do that effectively?
So on this, and this dovetails into the presentation, the most important thing is twofold. It's number one, venture investors are different than other types of investors. We want to invest in things that have 100x potential, right? If we put $1 into a business, we want at least the opportunity for that dollar to return 100-fold, and do that on a basis based on our check size, right? So you need to, number one, be in a big market and a market that's growing, right? So, there's some companies, there's some businesses, there's some industries that are just not venture scale businesses. And that's totally fine, by the way. Like you can have like an awesome business, an awesome service business that's just not a venture scale investment, and like do great, make money, take care of your family, like take care of your employees, like all that is said. Make sure that you're telling a story that's venture scale, right? You're operating in a big market, you're operating in a market that's growing, and you're operating in a market that is ripe for a new solution or disruption. So it's number one, it's got to be like a big, exciting market opportunity. And then number two, it's all about you, right? What is the unique insight? I like to call it, like, what is the secret that you know about this market that nobody else knows, that if you're right, can turn this into a massive opportunity? I go back to the first time I talked to Jason Fairchild. We've talked about this almost ad nauseum on this pod, but I think it's a really good example. Jason came to me and said, hey, I know you're investing in CTV. Everybody's excited about CTV. Here's the secret, Eric. They're all wrong. This market is not going to just grow because broadcasters are going to incrementally shift billions of dollars every year from linear to streaming. There's a whole pile of money just like waiting for this, and it's way bigger. It's performance marketers, and I think performance marketers are going to jump into CTV. I dropped my pen when he told me that. I was like, oh my God, if he's right, this whole thing is bigger than anybody's thinking about. And, 5 years later, this category of performance TV, which is a giant business with like multiple entrants that are doing really well, has come to life and has really achieved its objective, right? So what's the secret that nobody knows about this market? Why now, right? Like, why is now the time? Why is your team the team to bet on to go after this large, growing, attractive, but about to be disrupted in the right way type of market, right? It's like big opportunity, and then all the stuff that only you know.
To summarize your points, 1, articulate the size of the opportunity and make it seem big in venture scale. 2, share your unique insight or secret. And I think 3 and 4 were why now and why this team.
Exactly. And if you do that, you're going to have, I think, the beginning of a great conversation. And this is all about like just getting in door, so to speak, and starting off on the right foot. If somebody did all of these three steps, right? Like they came through a trusted connection, or I felt like I knew them from some of my interactions over time. An investment that will probably be announced by the time this pod hit is a founder I've been talking to since 2018. I missed investing in their first company that was acquired by Beep. They went into stealth mode for some time. They emerged from stealth mode. I sent a rare cold DM on LinkedIn, like, hey, what's going on? What's the new thing? He replied 2 years later, okay, I'm ready to talk. Like, this is a long-term game. So, it's like either come through the right place and leverage some of your social credit or develop a relationship when you're off cycle, right? So it's like, get in the door the right way, make sure your materials speak for you and don't like hold back on your materials. And then ultimately tell the story about why this is exciting and a really interesting, like compelling venture scale opportunity.
Four is a classic. Your fourth piece of advice is a classic how to get a job or how to get a client piece of advice, which is do your homework. In other words, actually think about the person on the other end of the table and why they specifically are a good fit for you.
Yeah. So we're transitioning from like how to get the meeting, and then these are maybe some tips of like what to do in the meeting. And there's ad nauseum materials out there of like, like how to actually pitch a VC. We won't talk about all that. The thing that I find compelling about some founders is they tell me why Aperium is a good fit for them. And that comes from doing the homework. That comes from like, looking at the investments that the firm has done, looking at the background of the partners and what they've built over their careers, or if they've built things over their careers, all they've put out in terms of content and thought leadership and opinions. There's a really easy way to figure out like what Eric Franchi or what Joe Zappa is interested in. Like there's no secrets here. And most importantly, where you think that we as people and where Aperium could add value. We're easy because we're sector focused. Some venture investors might be a little bit different if they're generalists, but flip the table and say, hey, I'm excited about this meeting because I think you're the firm for us. And here's why,
Yeah, it's funny because I just put up a job posting for a writer position. So I'm getting a bunch of applications from like 22-year-olds because it's an entry-level role. And that is one of my like biggest pieces of advice. Like if I could tell like new grads do like three things, one of them would be to personalize the application, right? And it's always like, it's the same thing with raising money. Like you're probably talking to like dozens of funds, right? And so it's hard to personalize for all of them because frankly, you just want to get the damn emails out or decks out. But personalization goes a really long way, and you're generally better doing fewer applications or fewer emails and making each one good than just like doing hundreds of them.
Yeah, I get it. It's I think a very good parallel. So yeah, do the homework. Every sale, we're talking about the same stuff, right? Like, don't walk into a room and be like, hey, what does your company do again? When you're trying to sell them something, like do the homework, be prepared, be ready to have something like relevant to say. Listen to the Shiv podcast for more of this type of stuff. It's all the same thing, but just do a modicum of homework.
It's all sales, raising money, sales, hiring sales. You're always slinging something. All right, number 5, ask smart questions. And what would such smart questions be?
When I was thinking about this, it's a little bit less like, hey, what's your view on ad CP or, the future of privacy or, kind of something maybe like industry or technology specific. I think if you're a first-time founder and you've not had venture investor conversations, there's some things that you should know going in that will help you understand or talk about in the meeting that help you understand A, how their fund works, and then B, are they a fit for your specific investment opportunity, right? So first example is check size. Some firms, explicitly put out there, we are a pre-seed or seed fund. We invest $500K to $1.5 million in pre-seed and seed deals. We do this, right? Like they put that info out there. Oftentimes that info is not out there. So you need to ask the question in the meeting. If you're looking to raise $1.5 million and the venture investor writes 50K checks, okay, cool. You know what to expect from them. Or if you're talking to an investor that, is somehow you've networked your way into a conversation with a firm and a partner that leads Series A rounds, and they're looking to put $5 million to work, $10 million to work, and you're looking to raise $1 million, like there's a disconnect here, right? So like, what is your typical check size is number one. So then you can then start to do some of the either mental math on, is this fund and is their specific fund you're talking to correct for you? And then what could they be in terms of your ultimate round? Can they lead the round? Can they be part of the round, the syndicate, so on and so forth? So it's like check sizes. Do you take board seats? Do you lead? Do you look for a certain like target ownership percentage? All of this stuff is important to ask as part of your conversation. So that's number one. And then number two, this is, important. And again, this information is not necessarily out there. It's important to know where funds are in their fund cycle, i.e., are they actively deploying right now? Are they raising their own fund and they're looking to be, deploying in a month from now? Are they at their tail end? Are they making their last investments out of their current fund and you're fighting for like one of the final slots? It's important to understand where they are in their fund cycle. VCs run in 3 or 4 year cycles. By that, I mean, they will raise a fund and then deploy that fund over a course of 3 to 4 years, typically. And then they're out raising their next fund. So you need to understand where they are in their fund cycle to figure out if this is an actionable opportunity for them and for you. I'll stop there. That was a bunch of inside baseball stuff.
At what juncture do you ask these kinds of questions? Like, is this something you ask in the meeting or these things you ask leading up to a meeting?
Yeah. I think if this is a net new relationship, you were like, networked your way in. Somebody said, let me see the deck. Oh, yeah, cool. Let's speak next Monday. These are appropriate questions to ask in that meeting. You may get all this information in the 5-minute preamble that the VC might do before they ask you to do your presentation or jump into the product, or you might jump right into it and then ask it at the end. But it's important to know, and I would want to have this information sooner rather than later.
You had a couple other key questions people should be asking. For example, how decisions get made and timeframes.
Yeah, exactly. These are all questions that I'd ask, and these are, one sentence answers compared to, my long diatribe of, setting this stuff up on the pod here. You want to know, how does the firm work? Like, are you having the first meeting of 3 meetings? Are you having the first meeting of 4 meetings? Where do things go from here? I've met with Eric. Do I then meet with Joe? Do I then meet with the entire partnership? And then how does this thing actually turn into an investment, right? It's important to understand like how the firm works. Is it one meeting, then to the partner meeting, then to a vote? Is it one meeting to a partner meeting to multiple customer calls, then a vote? It's just like understanding how the firm works is important. Yeah. It's the same thing with sales. Who's involved in the decision?
That's what I was going to say. Yeah, you want to know if there's a decision maker, whom we got to get in here, what's the timeline, that kind of thing.
Yeah. A lot of this is for first time. I want this information out there for first time founders, for founders that haven't done this before, because this is very, very difficult.
No, I totally agree. It's also not, this is great. I mean, I think anyone who's raising in or outside ad tech should give it a listen, but it's also, even if it is intuitive sales stuff, not everyone would intuit that ports over into raising money. So I think it's great to establish the parallels.
Exactly, right. How does the decision get made? And then at what pace does the firm work? Right? Do you make decisions quickly? Does this, is this a 6 or 8 week process? Like, the more information you can get from the firm, the better you are at managing your process should, you all partner up together.
Yeah, your process and your expectations. I always think when I ask the client at the end of the first sales call, assuming it went well and whatever, I ask about, is this something you're looking to do immediately or, whatever. It's always like I'm girding myself for like, is this going to be like a 2-month process or like whatever? Yeah.
But you got to know.
It's good to know. Yeah, no, you got to be able to set your expectations.
At Aperium, we, like when we're actively deploying, like, we look to move at, faster than market pace to help catalyze rounds, to help founders, kind of get in business. But not every firm can or does work that way. Firms just work differently. They all have different models.
All right, let's move on to some of the don'ts. So these are just, pet peeves, things people should not do. Number 1 was manufacture FOMO.
Yeah, this happens. So by this, sometimes I get an email, and it could even be an email that's not like a cold outreach. It could be from, somebody did the right thing and, got networked their way into a warm intro. And it's, oh, by the way, like, we've got 90% of our capital already committed. We got a term sheet from X. We're closing at the end of this week. We'd love to have you involved. It's really difficult. I mean, firms oftentimes like to move at, the fastest pace possible, but like just trying to manufacture like FOMO, like, oh my God, I need to get into this opportunity, but I need to make a decision in a time frame that does not allow me to do my work and talk to my team and diligence and everything like that. Like, A, it rarely works, and B, it ends up being a turnoff. Like, just don't do that stuff.
It's funny. I see it with agency owners sometimes too. Like I'll see like owners of small agencies on like LinkedIn being like, we're only taking 2 more firms this quarter or whatever. And I'm like, no one really cares. And like, honestly, I don't really believe you. And even if I did believe you, I don't think that would really make me be like, I want to talk to you. It's not like it's not a Rolex. I'm sorry to say.
No, definitely not. Definitely not. And like this would happen in the ZERP era. So circa 2021, there was so much money sloshing around and so many, kind of startups forming that I would get these emails quite often. Like, hey, we really want you involved, but like, can you talk today? Because we're closing this thing tomorrow. It was just like, oh my God. And then I've learned over time that, if the opportunity is right for all involved, there's time. You can figure stuff out and push deadlines to get the right people involved in your company. So don't go for the FOMO tactic. Never works. Turn off. I remember everybody that pulls it.
Don't number 2, overload on advisors.
Yes, this is something. There's like a X for everything. There's like ad tech X. There's crypto X. There's like fintech X. And there's a little bit of like, kind of VCX. And this is something that comes up, once in a while, but I believe it, oftentimes like a team slide where it's the founding team. And like, this is a slide that's very, very important to me. I want to know like the composition of the team, what they've done, where they worked, what they've built, like super, super important. And then sometimes, so you got like your core team on top, 2, 3, whatever. Yeah. And then there's like 10 people at the bottom, a list of advisors. I don't care who they are. I don't care what they do, like where they work. Like there's just like the roster of advisors for an early stage startup does nothing. And it could even be a negative signal. Like if you as a founder are spending all your time trying to recruit advisors for a little bit of equity to do, I don't know, just like lend their brand to your business or open some doors for you, it might not be, from my perspective, the best way to spend your time. And then also it's like, hey, why are you giving away so much equity, in your business right in the beginning? So the wall of advisors, skip it. You can do it. I wouldn't necessarily put it as, valuable real estate on your 1 team slide, or worse, have an advisor slide in your 10 slide deck. They only have 20 minutes to go over.
Yeah, less is more. Like, who are the people really driving this business forward? And like, the advisor who's kind of like your second cousin twice removed, like not the person. Don't number 3, pitch with an exit slide.
We may have talked about this in the past. This might be a thing, that's like kind of personal for me, but you're a brand new startup. Maybe you've raised a little money, maybe you haven't raised money, maybe you've got product market fit. Like, I sometimes see a slide that lists who the acquirers of the business will be, or worse, the time frame that we think these businesses will acquire your pre-revenue or 100K, ARR business. It feels, at best premature, at worst, like just crazy. We might have some internal conversations around like, hey, if everything goes according to what these founders say their plan is, who might the logical acquirer for this business be? But startups are a long-term game, and you will grow, you will pivot, you will change, and you have no idea who the ultimate acquirer of your business will be, if anything. Focus on building a big business and solving the problem, and all of that stuff takes care of itself.
I think I'm forgetting who this was, if it was like a famous like tech person or if it was like one of my colleagues, but someone was like, I hate when people tell me about who they're gonna be. Like I'm gonna be the number one, like this or that or whatever. It's like, just tell me like who you are now, what you're doing. Like, tell me about like the hard work that's going on now, not about like some like dream or like hallucination about like, who I'm gonna like. It's good to like paint a picture, but it's like it can quickly go over the line from like ambitious or visionary to like obnoxious or presumptuous when you're like, I'm gonna be this. You know what I mean?
Yeah, very, very, very well said. And it can also invite just debate or friction that you don't need. Like if you have that slide, okay, yeah, Oracle's going to buy my business in 18 months. The VC might have a particular insight into the inner workings of Oracle and just be like, no, and here's all the reasons why. Like, don't invite that friction. Unless you don't know and you've had conversations with Larry Ellison, he's like, yeah, kid, I'll buy your business in 18 months.
Yeah.
Just don't do
It's
it.
also like the company's probably going to change so many times by the time it is acquired. So yeah, exactly. So
Yeah. Leave yourself some optionality. Leave it open to dream a little bit.
Also, if it's an ad tech company and they're pitching an ad tech specific investor, you're going to know. Like anyone they're saying like, well, we could be acquired by these like you'll have thought of it. So it's also just like not necessary. Okay, final don't number 4. This is you telling everyone to take your rejection gently. Don't take a no personally.
Yeah. Venture investors will say no way more times than they will say yes. It's a function of starting with how many deals they look at, right? Some funds look at hundreds of deals for every like 5 that they do. Some look at less, but every investor will look at a lot of deals before they find what is something they can wrap their head around, get conviction around, get their team bought into, and then ultimately where they can like help, right? So you're going to hear no a lot. Like that's just a function of, again, sales, because it's a function of everything. And I would say, sometimes I hear founders, and maybe this is helpful, right? Like, Mafi just takes all of those no's, inserts them into chips on his shoulders, and then runs a million miles an hour to prove everybody wrong. And that's great. But I would say don't take a no personally. Like funds look for fits, and those fits can be based on so many factors: valuation, what subsector you're in, do they have competing companies? Like, do you have the team composition that aligns with like what they tell their LPs they look for? There's so many things that are both in and out of your hands and also subject to like market dynamics and timing and how many investments a fund needs to have, that sometimes like a fund will have to say no on a deal they might be on the fence about or is great and it's just not a fit for them. But I would say if you do the work and, you have the conversations, you will ultimately find investors that are the right fit, hopefully, for your business. But don't take a no personally. This is just, it's so much of this stuff is an inexact science of trying to find like the right investor for the right team.
Beautiful. I'm going to finish by running down the list for the folks so that if they want to remember everything, it's easy. All right.
Go.
Do's. 1, get a warm intro. 2, send the deck. 3, frame the opportunity. 4, do your homework on the fund. 5, ask smart questions. And you can go to that section if you want the details. Don'ts. 1, manufacture FOMO. 2, overload on advisors. 3, pitch with an exit slide. 4, take a no personally.
Yep.
There's your wisdom all laid out.
Yeah, absolutely. Again, this is geared towards first-time founders, folks that have done this before, have their own way of doing things. Oftentimes it, aligns with what works over time. And I hope that everybody has a good fundraising Q4.
Eric, did you notice that my eyes were kind of like closed and beady and red today?
I did. I thought that the subject matter was boring, but no. Is there something going on, Joe?
I do want you to know that I did shed a literal tear during this session, and it wasn't because the perspicacity of your fundraising advice was so touching. It is because I have pink eye.
No way.
Yes, I've been broadcasting with pink eye. I'm on like day 4 and I've been on antibiotics, so it's actually like wrapping up. But I'll just be like doing work or on a client call on Zoom, and then I'll just like my eyes will just go blurry. So that's how we're operating this week.
Jeez, people, wash your hands. Joe,
watch out. Joe's on the loose. Giving you a pink eye.
Unreal. Well, I hope your eye feels better. And listener, hope you all have a good week, and we will see you next week, everybody.
Thank you very much. Bye bye.